Good evening. I'm Epstein with your SPDR ETF stock market wrap-up, and what a day for today, Thursday, the 27th of April, 2023. All right, my friends. We started off, as you know, and I mentioned how strong the meta performance was overnight. You were up about 12% overnight, and it carried through the rest of the day. And, you know, rising tide carries all the ships with it, and that's exactly what happened. And the market went bonkers. Now, you had GDP come out. You had unemployment claims come out. GDP up 1.1%, not a good number. Did not meet the expectations. 2.5 or 7% of that came off of this because we're using inventories rather than building, buying, replacing, putting into storage inventory. We're drawing out now. When that ends, manufacturers either say they don't have the business to replace it or they got to go out and replace it at a higher number. Then we saw the consumer buying. And if you looked at the GDP where he's at, that consumer's strong. He's buying cars, he's buying durable goods items of all types. He hasn't gone away. We keep hearing that he's maxed out on his credit cards. We keep hearing that, bank deposits are down from some analysts because the consumer has no money. Those arguments aren't working. He seems to be buying big tickets somewhere along the line. So that is still going. Tomorrow we get consumer spending itself. First quarter PCE price index. I want to see what those are. What's that going to do? Do I think any of this took the Fed off base of a 25 basis point hike in May? I think it put them on base. It just locks them in. There's nothing to back off from. Is the banking situation gotten worse? Well, for one bank, it has, First Republic. If the short sellers could borrow the stock, they pound it down relentlessly. They can't get it. There's not enough float of stock, as they call it out there, to borrow it to get short. That's what I think is supporting the market, believe it or not, nothing more. Been around this, owned a stock firm. I understand the game. So what's really going on? It's the naysayer game. I've been saying this to you for months, not weeks, months on end. And I call the naysayers the people that keep saying, and they've been doing it from 3-4 months in on rate hikes, the Fed will end early. It'll never be able to go the duration. It's going to give up on getting interest rates down to 2%. The economy will weaken so much that the Fed will cave in. Okay, but how do you cave in if the unemployment claims keep falling? You get 1 week up, you get the next down, but you don't have a real ratchet where they're going up from a historical number that means anything. Then when you look at how the money's being spent, people are on travel, they're going to hotels, they're going out to restaurants, okay? That requires service people. Where do you think you're going to see this job show all the gains that are coming in? We know manufacturing and tech are letting people go. Gap just announced 1,800 people are going to be let go in corporate again. All right. It's company upon company. I get it. But it's company upon company hiring these people because you still need them in other parts of the economy. There's been a seismic shift ever since COVID came on the scene, and it's not done. Are we seeing a slowdown in the old-time economy? We are. You can't argue that. You are. What's carrying the market right now is AI, some cloud, but Amazon didn't do good with cloud, so not everybody's doing great with it. There are different parts going on here. So please understand that. Understand that you are going into a Fed meeting, and while the naysayers may not think it's important, you should. You should. Don't fall in their trap. The Fed has 2 mandates. Unless you're going to fire them or unless you're going to give them other mandates, it's inflation and it's full employment. They have not licked inflation. The low-hanging fruit was picked. Now you're in the sticky inflation, and if people keep getting these jobs, that only keeps it from staying and going to stay stickier. Now, the good news is that it looks as though wage costs have peaked, maybe, and they're now plateauing finally. You're not seeing a lot of wage demands from people going in. But if you left position A to position B, I'll bet that you're not going to make the same money that you made at A. I think it'll be higher. Because to get the people to come in that Group B company, they upped what they were paying to get the talent that's leaving A. Where's the talent coming from? So to speak, especially in tech, really skilled people going to startups, going to smaller size companies where their skills are super important, and it's worth paying up to whatever you had to get to the market, but you don't have to keep raising it. I think I'm explaining it in a way that I hope makes sense to you, because I think I'm onto something there. So Verizon, I really want to remove today's action. I told you, and I've been saying, there's a gap in this chart. Gaps like to be filled. I don't know how they'll get to it. Don't pretend that I do, but that's what's here. I saw nothing on this chart last night that was telling me you were going to go today and fill this gap. Boom. And where did it stop? It filled the gap. I'm laughing at it. Got down there, did its job, and where's it stopping? Oh, God. What do I call the red line to you? The line in the sand. It is where markets that get under it like to go back to figure out what to do. If you don't believe me, tell me what happened there. You don't have to believe me. You go up, you came down, you fought your battle down here to that average, then checked the 18, played the game again here, and then made your move. This is how moving averages typically, not all the time, but typically, give you support and resistance in them. They're not a forward-looking number. They're backward. They're an average of what happened. They're not telling you what's going to happen. So you've got two resistance points, the 18 to the 100. You're out of the downtrend. That washout is fait accompli. It's done. What else stopped the market? You hit the Bollinger Band. You were either going to just keep riding it or walk away. What really happened is, you see where this arrow is? The moment you took that out, you caught all the stop orders in the market, and the momentum turned. What did the momentum look like coming in? You're down at the Bollinger Band and you're oversold. What do I teach you here? This is not where I would tell clients to be short. This is where I tell clients I think the pros are covering shorts. Just the exact opposite of it all. And then you get these events, and especially taking out that high. Now in Schwab, with all the good news around it, it's still not picking itself up. Admittedly, it's no longer in a downtrend. It reestablishes a downtrend if you take out the lows of Wednesday. Take out this 50-30 and you open the door back up to the lower band. If the market can hang in here, the next resistance is up here, but you've got divergence. You have the market trying to be in an uptrend. It closed at 51.73, so the bias is down. It's under the 51.89 18-day average, and momentum is at best flat, maybe pointing down. In gasoline, you're at a zone that I think there's important short covering going on, real important short covering, not adding to shorts, short covering. The combination of the green, the 100-day average, the 200, and the Bollinger Band in an oversold market. If you take a look at futures gasoline prices, do the June contract, and run the weekly, you're going to see where the 18-week moving average is. In Tesla, bounces. It's a bear market. You got your embedded readings, you're getting a bounce. I'll be surprised if the pros don't try to go short tomorrow on a further rally in it. I would expect it. I would expect them to throw in the towel if the red line gets a settlement over 21, barring that. If the market rallies, I think they're going to hit it. In XLF, this is now the key number. Is the market going to go up and take out that high, or does it break under right through here, the 32.12 area, and go down to the 31.57. You're at an important juncture in this market. In XLI, the industrial sector, well, the one thing we can see is a downtrend. Lower highs, lower lows, a lot of resistance. I expect to see short selling coming in to 99.64 to 112 with stops right over this high of 101.20. And the objective would be a retest here. It couldn't make it to the 200-day average. Not a surprise. That's a big, important number. You hit it once and you turned right back from it. So we know this is a support value area, but we also see the resistance area on the chart. In SOX, which are the semiconductors, okay, you're in an important area here. You're, number one, if the market can get the red to close over 21, 5 points higher, then you open the door up back to here. You're at the 100-day average in the Bollinger Band. What did I say yesterday? And I'll repeat it today. That's a cover short area if I've ever seen one. You'll say, but Ira, it's embedded, and I'm agreeing. But you don't sell there. You're waiting for the rally and how far it can go without losing the embedded reading. In the home builders, I'm still bullish on them. I've been saying this for a while, and I know we saw some recent housing numbers that were not good. Okay, but these guys aren't building, going out and buying tracts of land and just throwing up homes. They're throwing up showcase homes. They're showing you what you can buy. They're working on you with the financing that they have deep enough pockets to carry in many circumstances. They can help you get your mortgages, and people want homes. And that's what's going on. Are home prices falling any longer? Well, if you're looking at the current stats, they appear to have nationwide have hit something of a plateau and have bounced a little bit. But you're in the season where people go out and they're buying, they want to get into the right programs for their kids. This is the time they're going, you know, I'm tired of the rent. The rent is already reflecting so much money. We want to build some equity, and you'll be able to refinance. And let's assume that you're one of those naysayers. What you're saying is, hey, interest rates are peaking here. If they're peaking, I can do refis on the way down. Yeah, it'll cost me some points or whatever, but I get a tax write-off on some of that anyways. That's what I'm going to do. That's what I think is going on to a degree. In the energy sector, to me, this is a cover-all short area. And I know you're going to tell me it's going a lot lower, Ira. You'll now, the guy that isn't the naysayer, the world's going to be in a recession, the U.S. is going on one, and that. Which side of the scope is this going to all work? If you read The Liar, and that is Novak. It was Novak out of Russia. He's their energy minister. They have met all their production target goals of cutting oil. How come all those ships are leaving their ports? Satellite pictures, everything showing. You can see it worldwide. What's really going on is in the energy, Russia and OPEC, not OPEC Plus, have carved out the world. Russia's getting the Asian countries that it can do business with, and the Saudis are getting the rest of the world that they can do business. And everybody says, yes, we're going to cut production. We'll let Russia do what they have to at $27 under Brent. We can all live with those prices. They're really not competing with us for our markets because they're not in that market that we've taken from them for both the refined products and the oil. I know you don't believe me on this. It's a backdoor deal. In the gold market, lower highs, lower lows. I'm looking for support right through here. I don't think anything's wrong with gold. I think gold will come into its own again after the next Fed meeting. I think that we'll get that headwind out. I have no idea how the market's going to react to what Mr. Powell will say. I don't expect he's going to deviate at all. I think he's going to say inflation is sticky in spots they didn't expect. They see that they've made some headway on headline inflation, but the core inflation is very, very sticky for them. The jobs market remains stronger than they thought. And the service industry is very strong still. And what else can he say? Now, if you're going to read into that means they're cutting in June, so be it. I'm telling you, that's what I expect. We'll see on Wednesday night if I was right or wrong. Okay? I'm laughing about it. In the silver's stuck at the 18-day average and volatility's come out. Do you notice how this market has narrowed in the Bollinger Band? Similar to gold. You're not getting big moves now out of the markets. They're in a pause. You had your big run-up. You're consolidating this run-up. Does that sound right to you? Markets that move up at some point go sideways to consolidate. Example, consolidation. Then a trend begins. In this case, it was a downtrend. From there, the market moved, consolidated again a bit here, and then made another move to the upside. This is what markets do. Get used to it. In the copper market, it's so interesting. The COPX is so much stronger of a chart than copper itself. It doesn't have a trend. It's got a higher high, lower low, and as it should do. It's picking on an average that it hasn't been at since March, over a month ago now, coming into May almost, and it's finding a little support against it. If that gives ground, then 37.50. Now, be careful of this market because this is the time of year where in China you normally drop in production. You drop in production of goods, the yen normally falls at this time of the year. I can only tell you what the norms are. And if that happens, also, there's no need yet for the copper at the beginning of it. Now, as we get through the summer, then you start ramping up for the production that'll happen in their fall. I'm giving you the what ifs, the norms. Every time's different, but I don't think this year's different. In TLT, you had the run-up, and I said, are you really going to bet? And I kept saying, I know it's the 20-year plus, and I do think that the 20, 30-year, no, we've probably made our peak on the numbers there. But it's still going to be drawn on by the shorter term, whatever the Fed does, and you're back to 4.035 on the 2-year yield, to give you an example. So you're back to 4%. If you're looking at Rick Reeder, who's one of the best analysts out there on these markets, he was telling you, hey, you can pick certain munis. There's cherry picking to get 6%. It's a gift time. Why people taking risk in the markets when you can lock in some of these? How could you deny that? 6% return on some of them. We were 5% just recently in the 2-year, and I was saying to people, why are you doing anything but locking in those returns, all right? They make sense. And I'm not talking 30-year. I'm talking 2-year, 1 year for some of your money. You rotate your money. Okay. In the FXE, that tracks the euro. I see resistance there. Am I long-term bullish? You betcha. Am I right here? No. You're overbought. You're at the resistance point in front of an FOMC meeting. So what do I think? I think the pros are going to take some money off the table. Now, I want to remind you, with everything you see me trading here, we cover this at Linn. Why? Let's talk, for example, TLT. We were just on it. Well, what do you think? It's not looking at the bond market, the 10-year notes, the 2 years to see what the curve yields are? Let's talk DIA, SPY. They're based completely on the futures market. GLD, based completely on the futures market. SIL, based completely on the futures. COPX, based completely. So why don't you want to learn what the pros are saying in the futures and what they're seeing? That's what we do. And then I help you translate it into the stocks and the ETFs that are doing those. So if you go to iraepstein.com, you'll see free offers from our research. Get it. It's free. Take a 2-week trial. That's all it is. No credit cards. That's not what we want. Look at our charts of the day. Look at our special situations. Look how we're covering it for you. And you don't have to get every report. You can work with us, and let's assume you only want to get to stock indices. We'll just make sure you get those. The stock charts, we'll make sure you get those. So how do you do this? You can either call my staff to work with you and have it done like that. You can go to iraepstein.com, free offers. You can move your cursor up here, free offers. So I'll see you first thing in the morning. Should be an interesting Friday as we get more reports, and then we go into that lockdown right in front of the FOMC meeting. And being a weekend, I'm going to put out your weekend reports for you as well. One final thing. If you like what I do here, thumbs up, please. And remember, you can hit join on YouTube to get into those morning videos. It's a blue button. You can't miss it. Take care.